Hi, welcome to today's episode of Informed Investor. In this episode, let's talk bonds. From government bonds like treasury bills and government securities to the corporate bonds that fuel the growth of businesses, we'll discuss the distinctive features that define each type. We'll also decode essential bond terms such as face value, coupon rate, maturity date, yield, etc. We will also understand how bonds are initially issued and later traded in these markets. We will then discuss the challenges faced by the retail investors in the corporate bond market. In addition, we'll also delve into the growth of India's bond market and talk about some notable developments seen in 2023. In our last segment, we will discuss some very important factors one needs to consider before diving into the world of bonds. Let's begin. You're watching Informed Investor, an initiative by Research and Ranking. The world of financial instruments is diverse, with stocks and bonds taking the center stage. When we talk about stocks, we're essentially talking about common shares, which are a form of equity ownership in a company. When you invest in stocks, you're becoming a part owner of that business, and as the company grows and performs well, the value of your shares also increases. Now let's contrast this with bonds. When you buy a bond, you're essentially lending money to the entity that issued it, whether it's a company or a government. However, unlike stocks, holding bonds doesn't grant you ownership rights in the company. Now, while there are no ownership perks, you do get the promise of regular interest payments and the return of your principal when the bond matures. Now, there are two main issuers of bonds. Number one is the government. The government requires massive investments in building airports, bridges, roads, and of course, clean energy infrastructure. The government funds its expenses primarily through taxation, but that's not always enough. More often than not, it will have to borrow money from investors. The government then raises money by issuing bonds. Such government bonds are issued by both the central and state governments as well as municipalities. Now, these bonds are considered to be the safest investments considering it is backed by the government, but it does come with lower yields compared with other bond instruments. Now, there are different types of bonds that government issues. One such as T-bills. T-bills are short-term sovereign bonds with maturities of 91 days, 182 days, and 364 days. Now, these securities do not have any coupon payments. You can buy them at a discount to their face value. For example, a treasury bill with a face value of Rs 100 is issued at a discounted price of, let's say, Rs 98. Now, if you buy it, your gain at maturity would be 100 minus 98, which is Rs 2. Now, another type of bond are G-Secs bonds or government securities. They come with different maturities ranging from less than 1 year up to 40 years. And now India also sold 50-year-old bonds for the first time. Now, other types of bonds also include sovereign gold bonds, green bonds, infrastructure bonds, etc. As we mentioned before, government bonds are relatively low-risk investments. However, they come with some level of risk that investors need to be aware of, such as interest rate risk, inflation risk, which we will explain later. Now, moving on to corporate bonds. When a company needs money, it can take different paths. One common way is getting loans from banks, another way is selling shares to the public, or they can also borrow directly from people by issuing bonds. Now, when a company issues bonds, investors who purchase them essentially become creditors to the company. In return for their investment, they receive regular interest payments throughout the bond's tenure. The one key advantage for companies in choosing the path of borrowing through bonds is the avoidance of equity dilution. This means they don't have to give away ownership, maintaining control over their operations. Now, furthermore, the cost of capital is reduced because the interest expense on debt instruments are tax deductible. Now, it's worth noting the yield on corporate bonds tends to be higher than government bonds due to the associated risk of default, making them riskier than government bonds. Now, corporate bonds can be categorized into two main types, which are investment-grade bonds and high-yield bonds. Now, investment-grade bonds are issued by financially stable companies with solid credit ratings. While they offer lower risk, the yields are generally lower. Now, high-yield bonds or junk bonds are issued by companies with low credit ratings, and these bonds come with high risk. However, to compensate for the increased risk, they offer higher yields. Now that you know the issues of bond, it's time to know that the types of markets bonds are bought and sold. Now, bonds are issued in two markets, that is the primary bond market and the secondary bond market. In the primary bond market, the bonds are directly issued by the entities to the bond buyer to purchase. Now, the price discovery also happens through an auction process. Now, after the bonds are initially issued in the primary market, they become eligible for trading in the secondary bond market. The secondary market provides a platform for investors to buy and sell previously issued bonds among themselves. This market plays a crucial role in providing liquidity to bondholders, allowing them to sell their bonds before maturity if needed, and also facilitates price discovery based on market condition. Now, the regulation of the bond market is divided based on the types of bonds involved. The Reserve Bank of India, or RBI, oversees the regulations of government debt securities, while the Securities and Exchange Board of India, or SEBI, is responsible for regulating corporate debt securities, which includes both private and public sector entities. Now, let's move on to the bond terms that you need to know. Face value is the amount that the bond will be worth at maturity. Imagine you purchase a bond with a face value of ₹1,000. This means that when the bond reaches maturity, you will receive ₹1,000 back, provided the issuer doesn't call the bond or default. The coupon rate is the interest rate of the bond, and this interest is calculated on the face value of the bond. Suppose you have a bond with a 5% coupon rate and a face value of ₹1,000. The annual interest payment would be calculated at 5% of ₹1,000, resulting in ₹50 annual coupon payment. Now, do know that coupon payments are made annually, semi-annually, or quarterly. Now, if the bond has a maturity period of 10 years, the maturity date would be exactly a decade from the bond's issuance. On this date, you would receive the face value of ₹1,000. Yield is a very important concept in the world of bonds. Now, once the bonds are issued, they enter the secondary market and are left at the hands of the demand and supply forces to determine their current price. Now, bond yields are the returns you get on the bonds based on the market's bond prices. Let's say you bought the bond for ₹1,000, but its current market value is ₹800. In this case, the yield to maturity would be considering the current market price, which is $800, and your yield would be about 6.25%. Now, the yield matches the bond's coupon rate when the bond is issued, but changes later. In a sense, coupon rates are calculated on the bond's face value, while your yield is calculated on the current market price of the bond. Now that we've understood the basics, let's take a look at a practical example and learn how to read a bond. Now, every bond issued will have a unique name or symbol. The symbol contains all the information you would need. The security name seen on your screen indicates the name or identifier of the security. In this case, GS means it's a government security with a coupon rate of 7.32% and the maturity year of 2030. As we mentioned earlier, the coupon is the annual interest rate paid on the face value of the security. In this case, the coupon rate is 7.32% and it represents the annual interest income that the bond holder will receive. Now, maturity date is the date when the security or bond is set to mature and the principal amount is repaid to the bondholder on that date. In this case, it is November 13, 2030. Time to maturity represents the remaining time until the security matures. In this case, there are 6 years, 10 months, and 6 days left until the maturity date. Now, indicative yields are based on the last trade price of G-Secs and are only for comparison purposes. In this case, it is 7.15%, indicating the return based on the current market prices. Now, minimum amount specifies the minimum investment amount required to participate in the bidding or purchase of the security. In this case, the minimum amount is about 10,800 rupees. Now that we have our basics in place, let's talk about the growth of India's bond market. Now, the bond or fixed income market in India has seen substantial growth. Over the last 5 years, there has been a remarkable 77% surge in the total bond market value. Now, breaking down the Indian bond market, government debt or government bonds constitute a significant portion, holding a commanding 78% market share, and in contrast, corporate bonds make up the remaining 22% of the market. Now, while the corporate bond markets have been growing, the accessibility for retail investors has especially been limited due to various entry barriers. Now, let's take a moment to talk about this. Let's say a company wants to raise money. It can directly raise money by privately issuing bonds, or it can raise money through public issue, which is more like an IPO for the debt market. Companies have traditionally favored private fundraising for bond capital over public offerings due to advantages such as avoiding the need to file an offer document with SEBI, thereby saving time, effort, and money. And in the fiscal year 2023, only 1.2% of the total funds raised through corporate bonds came from public issuance, while the majority flowed through private placements. Now, this exclusivity creates a scenario where retail investors were largely unaware of opportunities in the corporate bond market. Now, apart from restricted access, the pricing structure of corporate bonds in India also serves as a significant obstacle. Traditionally, these bonds were not attractive to retail investors due to the majority being issued through private placements with face values of ₹10 lakh or more. Now, fortunately, the barrier was low to ₹1 lakh last year. However, ₹1 lakh is still high for an average Indian investor. Now, to put it into perspective, consider how daunting it would be for people to invest in mutual funds if the minimum investment amount was ₹1 lakh. Now, thanks to a minimum investment requirement of ₹500, mutual funds became the favorite avenue for household investment in India. So, despite the positive change in reducing the face value, the ₹1 lakh ticket size for privately placed bonds still remains a challenge for some retail investors. Now, recognizing this, the Securities and Exchange Board of India, or SEBI, has introduced its latest consultation paper proposing a further reduction in the ticket size for privately placed securities to ₹10,000. Now, if SEBI implements the proposed amendments, millions of retail investors will gain access and the flexibility to invest in corporate debt instruments. Another big problem with corporate bonds is that the market where people trade them after buying, which is the secondary market, isn't very well developed. So why does this matter? Well, a good secondary market is like a busy marketplace. It makes buying and selling bonds easier. It's important because it helps investors quickly buy or sell bonds without affecting their prices too much. But it's not just about trading. A lively secondary market also encourages more companies to issue bonds in the first place. Now, if they know there's a strong market where their bonds can be traded easily, they're more likely to offer them to investors. This active secondary market also helps everyone understand the real value and risk of different bonds. When lots of bonds are changing hands, it creates a clear picture of what people think they're worth. In 2023, the Indian bond market also saw some notable developments. Let's discuss those. One significant milestone was the inclusion of the Indian government bonds in the JP Morgan Emerging Market Bond Index. Now, JP Morgan has created a basket called the Emerging Market Bond Index. Here, they measure the performance of international government bonds issued by emerging markets countries like India. Now, JP Morgan had excluded India from its index, citing that the Indian government bonds didn't meet their stringent requirements. However, India diligently worked towards meeting these. In September 2023, JP Morgan announced the addition of Indian government bonds to its benchmark Emerging Market Index. Now, this inclusion process would start in June 2024 with the weight of 1%, gradually increasing by 1% each month until reaching 10% by April 2025. Now, this move is expected to attract foreign investments, providing a substantial funding source for the Indian government. The anticipation of increased global recognition and investment made this development particularly noteworthy. Now, simultaneously, the government also took steps to deepen the bond market by opening certain categories of government securities to non-resident investors without restrictions. The introduction of the Fully Accessible Route or FAR by the RBI in April 2020 allowed non-residents to invest in specific government bonds. Now, this initiative aimed to attract foreign players and enhance market liquidity. In 2023, the foreign institutional investor flow into the Indian bond market reached a 6-year high. The central government's measures, coupled with the popularity of the Fully Accessible Route, which we just spoke about, contributed to this surge. And the expectation of their inclusion in global bond index further fueled optimism. Now, the Indian bond markets have shown resilience, and these notable developments have positioned it to further. The Indian bond markets have shown resilience, and these notable developments have positioned it for further growth. In our last segment, let's talk about a few key considerations that you must keep in mind when it comes to investing in bonds. Now, understanding inflation is crucial as it represents the increase in general price levels over time. This directly impacts the value of your money, gradually reducing your purchasing power. Now, let's delve into why inflation poses a risk for bonds. Suppose you're earning a 7% return on a government bond while the inflation rate stands at 4%. In this case, your real return accounting for inflation is a positive 3%. However, imagine a situation where inflation spikes to 7% triggered by a surge in food prices. In such a scenario, your real return on the government bond becomes zero. This implies that the return on your investment is insufficient to counteract the erosion in your purchasing power caused by the high inflation rate. Now, in general, the bond market is relatively safer, but they're still very volatile. And fixed income securities carry something called an interest rate risk. A fundamental principle of bond investing is that market interest rates and bond prices generally move in opposite directions. The relationship between interest rates and bond prices can be a bit confusing at first, but it's important to understand so you can make informed investment decisions. Now, after a bond is issued, just like stocks, it can be traded in the secondary market, causing the bond's price to fluctuate depending on supply and demand, any changes in interest rates, and any news about the financial health of the issuer. Now, for example, when interest rates rise, existing bonds with lower interest rates becomes less appealing to investors because they offer lower returns compared to newly issued bonds paying higher interest rates. As a result, the prices of existing bonds in the secondary market may drop below their initial par value. When the bond price decreases, its yield, that is the annual return on investment as a percentage of its current price, increases. This higher yield makes the existing bonds more competitive in comparison to new bonds with high interest rates. Now, usually long duration government bonds are much vulnerable to such risk. Coming to secured or unsecured. Typically, this does not apply to government securities but only to corporate bonds. A secured bond is backed by the assets of the company. The rates may be slightly lower, but they're much safer than unsecured bonds. Now, most corporate bonds are either liquid or the trades are limited. In case you don't intend to hold for the full tenure, you must have adequate exit options on the table. It ensures how quickly you can convert your investments into cash. Credit rating of the bond is perhaps the most important criteria. As discussed earlier, these fixed income securities can be issued by both government or corporate. Government bonds, commonly known as GSECs, are generally considered among the lowest risk investments because they are backed by the country's sovereign. The risk of default is extremely low for government bonds. However, corporate bonds can vary significantly in terms of risk depending on the creditworthiness. Typically, the AAA bonds are the safest bond with a very low chance of default. However, the yields are also lower on highly rated bonds compared to lower rated bonds. Now, many investors deliberately go down the rating curve for higher yields, which is not a well thought out strategy. Now, before putting your money into corporate bonds, we must also take a close look at the financial conditions of the companies issuing them. We must examine the company's profitability, debt levels, and the ability to generate cash flows when investing in corporate bonds. Now, a robust financial position lowers the risk of defaults, making your investments more secure. Bond interest is fully taxable in the hands of investor. However, there are tax-free infrastructure bonds like the ones issued by REC and PFC where the interest is entirely tax-free. We must also look at these factors before investing in bonds. Now, this was our attempt to introduce you to the world of bonds. If you have any questions, do let us know in the comments section. Having said that, this is me, Merl Zana, signing off. Take care.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.